So the big question, we saw fresh records yesterday. Can this rally, can it keep going with just one rate cut? And when do we need to see that cut to keep this rally going?
Well, at this point, I'm not sure the rally is dependent upon the rate cuts. The rally is dependent upon AI continuing to be a factor. This morning, we're up, sort of despite Powell's rhetoric, because Broadcom is doing the 10-for-1 split. Tesla's got, Elon Musk is signaling good stories out of Tesla. And, you've got NVIDIA up a couple of percent in sympathy with Broadcom. At this point, you got to ask yourself, how dependent are we on a rate cut? Because we've sort of outkicked the coverage if we're only getting one.
That's interesting. So I'm sure you're going to get a lot of calls from clients asking you that question. It sounds like you really think it's the market driving itself right now, specifically the tech trade. So I do want to ask you, Torsten Slok, chief economist of Apollo, came out with a note yesterday talking about NVIDIA and concentration risk. Just, important to note, NVIDIA was the biggest contributor to the higher close yesterday for both the S&P and the NASDAQ. But basically his thesis is that the market's so dependent on NVIDIA. If there's any downturn in NVIDIA, we're going to see a downturn in the market. When you're talking to clients, are you talking to them about concentration risk right now?
Oh, very much. This has been a theme of mine for some time, is that it's NVIDIA's market and we're all just trading in it. Basically, he put the numbers out there, but I put out a graph earlier this week just showing that the S&P has outpaced the mid cap and the mid caps outpaced the small cap, and the Mag 7 has blown them all away. And so it's really, the problem you get into when you have very concentrated leadership is it's fabulous while it works. It's fabulous while you have if you have those stocks. The problem is if something were to change the market's mindset, and I don't actually know what that is, probably lack of rate cuts could be one of those things, but it doesn't seem to be. It could be, but the problem is it's everybody trying to squeeze out of a very, through one fire exit at that point. It becomes very difficult.
All right, Steve, by the way, I know you put out your own writing. I don't want to shortchange you. In fact, you put out an article this week. It's about owning the correct stock. So I want to talk to you about that cyclical trade that a lot of people were bullish on earlier this year when we thought we were going to get more cuts. I'm looking since May 1st, the last Fed meeting. The S&P far outperforming, really driven by tech. Now look at financials and industrials lagging, both up about 1%, give or take. How do you view that cyclical trade? What other areas of the market are you bullish on? Are there other areas you are bullish on, considering the fact that we just don't know when we're going to get that rate cut?
To me, I think it's sort of safe at this point to sort of hunker down in higher dividend stocks. If we are going to get rate cuts, you want companies that are able to produce solid cash flow and then return that to shareholders. That's been a good theme, over time. Lately, it's not sexy, but that in some ways can be a very good way to go, especially if you do think that rate cuts are on the horizon. And I do think that at some point they're inevitable, although they just keep moving. They keep moving the goalposts on us. And that in that sense, that kind of fits in with the bigger is better trade, because the bigger stocks are able to, generate more cash flow on a solid basis. But I think getting that return is very helpful.
A lot of people talking about dividend stocks recently. I want to ask you, what's a good dividend in this current bond climate right now? I mean, if you look at the 10-year, yield's well above 4, other areas also above 4. What's a good yield in today's environment when it comes to a dividend?
I'm going to answer you with I'm going to answer with a non-answer to some extent. That dividend has to be good in the sense that the company has to generate enough cash flow to pay for it. They don't want to be borrowing to pay dividends. That's a red flag. But on the other hand, I'd say if you could start with somewhere in the mid 2s, you're talking about a pretty good dividend, because you do get the potential for capital appreciation when you own stocks. And again, if you just want the dividends, well then you might as well be in bonds. So you want a little bit of both in this case.